The first and most simple way to use pivot points is to use them just like you would use regular support and resistance levels. Remember in the support and resistance module, we learned about how we can trade the bounce or the break? The same thing applies here. With the bounce, the more times a currency pair touches a pivot point level, then reverses, the stronger the level is. And if you see that a pivot level is holding, it could be a good opportunity to trade. So with the bounce, if price is nearing the upper resistance level, you could sell the pair and place a stop just above the resistance level. And if price is nearing a support level, you could buy just above the support level and place your stop just below the level. It's just like you learned with support and resistance, right? Not too hard. So let's take a look at this example so you can really visualize it. This is a 30-minute chart of USD CAD. In this chart, you can see that price has risen just up to this R1 resistance level. If you think it will bounce off this level, you can place a sell trade just below this line and put your stop loss order past the next resistance level, or R2, up here. This would be a conservative way to approach it because it will give your trade plenty of room to breathe, but if the market does get all the way up to R2, chances are it's not going to come back. If you're a little more aggressive and confident that the resistance at R1 will hold, you can set your stop just above the R1 level. And then for your take profit, you can either put it at the pivot point line or even the S1 level, which could provide some support in the future. So let's see what would have happened if you had placed your sell trade just below the R1 level. And bam, looks like the R1 held as resistance, and if you had your target profit at the pivot point line, you would have profited. So now you see the market is at the pivot point line, right? And you think it could be bouncing off of that. So you place a buy order, and then you put your take profit at the R1 level and your stop loss below the S1 level. Now let's see what would have happened. Bam, the market shot up and hit your take profit again. Now you see the market moving back below the R1 resistance level, and you decide it's time to sell again. So let's see what would have happened. Boom, we're on fire, right? So that one reached all the way down to the S1 level, and then you can see even from there, it bounced off again and came all the way up and hit the pivot point level once again. Of course, as you already know, it isn't always going to work out like this 100% of the time. To increase the odds of you getting in a good trade at a good time, you can combine pivot points with other indicators. For example, if you see a doji candlestick is formed over S1 and the stochastic is indicating oversold conditions as well, then it might be a good time for you to buy. Normally with pivot points, trading takes place between the first levels of support and resistance, but price will also sometimes test the second and third levels. And sometimes price will just break through these levels instead of bouncing off. In fact, in the next section, we're going to go into a little more detail on how to trade the break.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.